Trying to raise debt in the local market is a growing challenge for the engine room of corporate Australia, mid-cap companies. That's the view of former Minister for Finance and Deregulation, Lindsay Tanner, now a Special Advisor to Lazard Australia. I spoke with him just after he gave a speech in Melbourne on what's impeding the development of Australia's financial markets. Lindsay Tanner, thank you for joining us.
Thanks, Tiggy.
Well, let's go to the corporate bond market first. You say that a lot of the market's problems are self-generating. What do you mean by that?
Well, major investors are concerned about investing in corporate bonds because there is a relatively illiquid market. And the experience, of course, a few years ago with the global financial crisis is that having a big exposure to illiquid assets is not a great place to be. So there's a bit of a catch-22 here, but there's a lot of separate factors involved here in the weakness in our corporate bond market. It's quite a complex issue to deal with, but it's something that increasingly a lot of our upper middle-sized companies are quite concerned about. It is a major constraint on them.
Yes, it's funny because I came across an interesting letter from Metcash in response to the Treasury's corporate bond market discussion paper late last year, and it was classic. It wanted to raise funds. It ended up going to the US private placement market because the preparation time and the cost to go to the Australian market, with actually no guarantee that there would be a decent market here at the end of it.
Well, that's right. Regulatory issues, excessive regulation is a problem in Australia, but the government is acting to address that. It's only one of a number of issues. At the moment, very low interest rates in international markets skew the balance in favour of placing your debt offshore if you're big enough and serious enough to be able to do that, even though, of course, there is currency risk involved. But the critical factor underneath all this is that if there's not much of a market domestically, particularly not much of a retail market either, well, then you do have a significant worry and you're going to be up for pretty hefty investment bank fees to underwrite your issue. So there is quite a complicated problem with a number of different factors here.
You say it's a problem for smaller companies, but many of these companies are not that small. Market caps of what, $1 to $2 billion?
Well, that's right. In fact, it's really the engine room of our economy that's the worry here. The really big guys, the Telstras, the BHPs, they can go offshore and they do, and it's pretty straightforward. But of course, for companies a bit further down the scale who are much more numerous and inevitably central players to all the sectors in our economy, that's not quite as simple. A lot of major companies don't have credit ratings, for example. So there are a whole lot of different issues here, and we really need to ensure that the Australian domestic savings pool is doing more of the heavy lifting. Even some of the banks now are coming out and saying, look, we will not be able to do as much of the job in this area as we have done in the past, partly because, of course, superannuation is growing as a proportion of our total savings.
You mentioned superannuation there, and of course a lot of corporate debt is tied to super. That was the other point you were making, I think, in your speech today. And there's a lot of concern about the amount of super that's been directed towards equity rather than debt.
People of the stature of Ken Henry, David Murray, Jeremy Cooper, Mark Johnson, all bell the cat on this question over the past month or two, asserting that the Australian superannuation system, the core of our retirement savings system, is excessively exposed to equities. In other words, the risks are too high. There's a long-standing debate here. Equities deliver, on average, over time, higher returns. But of course, you can cut the statistics any way you like to produce whichever result you want to put, whichever side of the debate you happen to be on. And the long term is not much benefit to an individual who's compulsorily invested in super. You don't get a choice, your money is going into it, and who gets tax preferences for it. That individual may be on the wrong end of a bear market in equities and could see a savage impact on their retirement income as a result. We had a bit of that during the global financial crisis. So there is a really big question I think our society needs to debate here, and I haven't got a concluded view on it as yet, but I'm really grateful for the fact that people like David Murray and Ken Henry have bounced the ball. It's a very important debate for the longer-term future of the Australian economy and also our retirement system.
Well, of course, you were Finance Minister and Minister for Deregulation. A while back, we had something called the 30-20 rule, where at least 30% of super funds investment had to be in government bonds. Now, do you think this is something government should look at, or maybe more on the tax side, a tax change perhaps by reducing the 15% tax rate paid on superannuation returns for fixed income products only?
Well, generally in government, whenever these kind of questions emerge, I was a sceptic about government intervention. I felt that the risk of causing more harm than good was quite high. So generally speaking, I'm very nervous about any suggestions for government intervention, but there are quite a wide range of options. You've mentioned one of them. You can tweak the tax arrangements to, in effect, create some incentives for more balanced portfolios than we've currently got at the moment. You could intervene through the Future Fund. I wouldn't advocate that, but that's one of the options the government has got. It is a major investor in its own right. It could do a variety of things. Now, I think there is a really important public discussion that's got to occur here first before any of these options are even contemplated. But to those who would resist blindly any kind of government intervention here, they need to understand that we're dealing here with a very distorted market. Firstly, it's compulsory savings. So a very large sum of money off the back of millions of people's productive activity is compulsorily directed to this particular kind of savings. And secondly, it is highly tax preferred. Thus far, the response from the super fund sector, I think, has been insufficient. They've emphasised the higher levels of returns that typically, on average over time, emerge from heavy investment in equities, but you've also got to look at risk.
Lindsay Tanner, thank you. I'm sure your counsel is much missed in Canberra, including in the press gallery, who I know you love and adore.
Thanks very much, Steve.